to the Brandon Lakey Show.
Welcome. Good morning. Welcome to the Brandon Lakey Show, Compounding Communities, where we're talking about all things that are in our communities. Compounding communities being the idea that if we all come together, we all work to help make our communities the best possible places they can be, that the combined efforts of all of us can make our individual communities just the incredible places that we know that they are and that they can be. And the reason why most of us, if you're in the Dallas-Fort Worth area, especially North Dallas where I'm at, the reason why most of us moved here. So I want to welcome you to the show. This show is powered by WealthWave, the How Money Works company, and also The Difference, brought to you by Revolt Healthcare. And so I want to welcome you. You know, we have been super busy. A lot of cool things have been happening personally in my life. 2 weeks ago, I had a son born, little Rhett. And so super excited. Rhett's doing great. Mama's doing great. So appreciate all of you that have reached out with calls and texts. And, you know, some of my really close friends, you guys, you know, I can't thank you enough for flowers and food and stuff that you guys have sent. It's been absolutely phenomenal. And so, you know, we're officially a family of four. And just, you know, as a nod to any of you guys out there listening that have two or more, I don't know how you do it. So kudos to you. If you've got 3 kids, holy moly, I've got some friends that have 3, 4, 5 kids. I don't know how you guys do it. So, you know, maybe we'll get you guys signed up to teach a master class in parenting, because it's an adjustment to go from 3 to a family of 4. So, you know, not getting a lot of sleep just quite yet, but, you know, we're turning the corner. We're at the 2-week mark. So that's kind of what's been happening. In addition to, you know, our WealthWave business has been just crazy busy. We've been so busy. This month actually is a big month. It is a huge pivotal month in our business and in our industry because it is Life Insurance Awareness Month. So today is going to be a special all about life insurance from an educational standpoint. So hold on before you think like, insurance, I don't really want to, you know, that's not super interesting and entertaining. I commit to you today that I'm going to show you a few things that could potentially be game changers to you. Things that I would almost guarantee you probably don't know. So before we get into that, you know, I want to also take a minute to let you guys know that what I'm teaching today is content from our How Money Works book. And so if you'd like a free copy of this book, you can comment in the comments, I'd like a book, or hashtag The Difference, or even hashtag How Money Works. Any of those things, we will have our people get in contact with you, get your name, address. We'll ship one out to you this week free of charge. I think they're $18 on Amazon. But last I looked, this was ranked in the top 2 or 3. I think it was actually number 1 for a while in the business and finance category. And so we'll send you one for free as a gift as a listener to our show. So I really appreciate you guys listening in. So we're going to talk about a master class for everything you need to know. This may be a category of topics in your life where you might think, I've got the box checked. I've got life insurance through my job, but this thing is ever evolving. I want to submit to you something really quickly. How many of you are driving around right now with an old Nokia brick phone, right? There might be a few listeners, but if you don't have an old BlackBerry or an old Nokia brick phone, the question is why? Why don't you still have those phones? They were good phones. The battery lasts on that Nokia like 4 days, 5 days. Why don't you still have those old phones? Well, because you upgraded. It became silly to still have those old phones. What I'm going to submit to you today is the world of life insurance is ever evolving, just like the world of cell phones and technology. So you may be under the impression that the box is checked because you have insurance coverage through your job. What I'm going to submit to you, I'm going to teach you some things today that might just shake your whole foundation, because there's some interesting things happening in the world right now where people are being taken advantage of, left out. Just this morning, I heard a story of a gentleman that passed away of COVID. What you may or may not know is Texas is an at-will state. And I'm going to talk about that here in a few minutes, because there's some crazy things that are happening out there right now that you need to make sure you're protected. You need to make sure that this doesn't happen to you and your family. So stay tuned. We're going to talk about that. So let me share my screen here, and let's kind of jump into some interesting information that I think you're really going to like. I think this is going to be a game changer for some of you. So, all right. So you should be able to see my screen, which is Life Insurance Awareness Month. You know, this is milestone number 2 in our How Money Works book, if you're following along with the chapters in the book. So what we're going to talk about today is all the essentials, what you need to know. We're going to go through this pretty quick. So hold on to your hats. Life Insurance Awareness Month 2021. And so here we go. So we're talking about proper protection. Obviously, this is one of the 7 money milestones in our How Money Works books. We talk about protection against loss of income and protection against loss of savings. So let's talk about this. What's happening right now? Well, we all know the thing that none of us really want to talk about, but still kind of lingering out there, the pandemic. And boy, did the pandemic hit American families hard. You're talking about in January of 2020, 36% of uninsured Americans said that they needed to get some more life insurance. It is a hot topic on people's minds. In May of 2020, more than 53% of Americans expressed a heightened need for life insurance due to concerns surrounding COVID-19. So we know this is something that for at least half of you've thought about. So if you're riding in the car listening and you've got your spouse with you, look over at him or her. One of you thought about this over the last couple of months. So, you know, just know it has crossed a lot of people's minds. So, you know, when we talk about life insurance, what I'm going to talk about is some living stuff too. So if you're thinking we're only talking about something that you have to pass away to use, just know that there's going to be some really cool features we're going to talk about here that you may not even know exist. So when you talk about the concept of life insurance, you know, Thomas Paine said the protection of a man's person is more sacred than the protection of property. You know, self-preservation is important, but you can't always predict the future, obviously. So what we're talking about is the concept of making sure your loved ones and your family are taken care of. We're also talking about the concept of future-proofing yourself, future-proofing your income. You see, there's 2 plans that can happen for your life. There's a plan A, which is everything in your life has gone perfectly according to plan. And you know, from the time you were born, everything has just worked out exactly as you have planned it. You know, I'd love to be able to, if we were in a live audience, I'd love to be able to ask you to raise your hand to say, how many people's lives are still on plan A? No, not many. I would probably submit that most of us are on plan B, C, D, E, and that's okay because life throws us curveballs. But plan A is everything works perfect. You're able to work and live and save and invest a bunch of money, and you live to be 100, and it's all perfect. Plan B is something else happens. And if you're already on plan B, C, D, E, I would submit to you that having some protection in the eventuality that you might be on a different plan than plan A might be a worthy cause for you to give a few minutes of your attention. So plan A, you save a long time and your family has a lot of money. You get to retirement, you're able to fund your kids' college, you're able to live throughout in retirement, you're able to never run out of money till you pass away, take care of your spouse, your loved ones, your kids, your dependents, take care of everyone. That's plan A. If you just put money into a 401k, an IRA, a mutual fund, and you live to be 95 years old, plan A works great. But we know, especially with things like COVID happening, plan B says something happens to a loved one. And plan B, if you have life insurance coverage, your family wins, even if you're not here. So plan A, you live to be 95 or 100, you and your family wins. Plan B, something happens to me, my family still wins. No matter what, my loved ones win. Okay, that's the game that you want to be in. You want to be in a game where you win no matter what, right? If you're in Vegas, you got chips on black, you got chips on red. No matter what, you're walking out of this deal smelling like roses. Somebody is winning in your family. So that's the concept of life insurance. It may be a little bit of a shift. So, how much life insurance do you need? Well, there is a good starting point here, and it's generally about 10x your annual family income. So here's what I'm doing. I want to educate you, but I also want to protect you from those people who are going to come try to be predatory and convince you that you need way more life insurance than you need and try to just sell you on a whole bunch of life insurance. Whether you need that is important, right? There's no point in paying for something you don't need. So, for example, if you earn $50,000 a year, you should probably have at a minimum $50,000 of coverage. Now, there are some variables that can adjust that up or down. If you earn $100,000 a year, you should probably have at least $1 million of coverage. Again, some variables that can move it up or down. So, what are some of those variables? Well, things like your age, things like your debt level, number of dependents. How many kids do you have? How many people you're going to have to try to put through college and support? Your role if you're a business owner, if you're a real estate agent, if you're a real estate broker, and you own a brokerage, you own a business. What is it going to take to keep that business going? There's a whole nother class of products when we're talking about key man and buy-sell agreements, using life insurance to make sure that the future of your business goes forward. Certainly your current health. But a big one is your income. How much income would you want to provide your sweetheart or your loved one, and for how long? And if you've got little kids at the house, that's the big kicker that a lot of people don't realize. I'm going to give you a quick example. What if you, riding along in the car or at your office right now, you make $60,000 a year, and you say, hey, if something happened to me tomorrow, I'd really like to at least provide my wife with my income. Well, how much in a lump sum needs to be sitting in some type of growth account that your loved one can pull money from month after month after month and have that money at least last 10, 20 years or longer? Well, the rule of thumb is that you can pull out between 4 and 6% off of a large sum of income. The longer you want it to last, the more, the less you can pull out. Don't get hung up in the math there. Very simply, if you have $1 million, your family can pull out about $60,000 a year, or essentially 6% per year off that giant lump sum. So if you want to provide your family at least $60,000 a year in income to replace your income, or maybe you're a higher earning individual, maybe you're making $100,000, $150,000, and you think, well, I would need to provide my sweetheart at least $50,000, $60,000 a year if I weren't here to keep running the household. Well, now you're talking about $1 million in coverage just to cover your replaced income. We're not talking about debts. If you want to try to pay off a mortgage, you want to send kids to school. So that's why there are some factors that a lot of people don't think about. And that income one is huge. A lot of people start to think, they say, well, if we paid off my house, if we paid off my car, the credit cards, the student loans, sent the kids to college, yeah, we're good with $500,000. But they discount the income part. And that income part is one of the variables that can raise the amount of life insurance you need up. So, we've got one of the characters, Dana, from our How Money Works book. She says, I have to admit, 10x your income is more coverage than I would have guessed. That's got to be expensive, right? Wrong. Life insurance has actually gotten cheaper over the years. And when we say cheaper, you can use lots of words, more cost effective, more economical. At the end of the day, what you're paying for life insurance has decreased significantly over the years. So there's this need cost assumption, this paradox that exists, which is saying the same people who typically underestimate how much life insurance they need also tend to overestimate how much it will cost. term insurance is so cheap. Basic term insurance is so cheap. It's crazy to me. In a lot of cases, you are paying more right now for the insurance on your iPhones than you would pay for 250, even if you're younger, healthier, to $1 million. I have clients that are paying more in iPhone insurance than they would pay for $1 million of coverage on their family, the protection of their family. Does that make a lot of sense? That's just wild. I mean, you start thinking about if you're paying for insurance for your iPhone, for your car, for your house, but you don't have insurance on your life and your family, but don't worry, we're not taught this stuff. They don't teach us this stuff in schools, which is why having someone that will teach you and educate you and help you navigate this stuff is so valuable. Only 59% of Americans have life insurance, and of those, half of them are underinsured. Okay, so you've got Dana and TJ here. TJ says, I'm guessing the amount of life insurance you need and cost depends on your individual financial picture. And Dana says, yep, that's right. There are things that you and your financial professional should talk about. Certainly, what are your short-term, long-term debts? What are some loans you have? What are your goals? How much is your mortgage going to be? Do you want to pay that off? How old are your children? Are you wanting to send them to a public, private, or Ivy League school? Do you have any assets currently that you could cover funeral costs, emergency funds, stuff like that? It's very expensive to die these days, unfortunately. I'm going to break this and keep this super high level, super sensitive. There's only two types of life insurance out there. You may say, well, wait a second, I've heard of all different types. Well, there's two big categories, okay? So stick with me on this. There is temporary insurance and there is permanent insurance, okay? Temporary, just like it sounds, it's here and then it goes away. Permanent, just like it sounds, stays. So let's talk about temporary, aka term life insurance. Typically provides protection for a term of 10, 20, or 30 years, okay? So the idea is it is to protect you for a short period of time, okay? You might start at the beginning with kids, have a house, pay for those kids. The end of the term might end at the time where your responsibilities are starting to decrease, okay? So what is term insurance typically used for? Well, for raising kids, if you have a mortgage. A lot of times when you buy a house, by the way, when I bought my last house, I got 56 pieces of mail. I saved all of them. 56 pieces of mail over a 90-day period advertising that I needed to have mortgage insurance, which is basically term insurance rebranded. But guess what? Because it's mortgage insurance, because they have it a fancy name, they're going to charge you more. It's basic term insurance, a 30-year term insurance policy for a 30-year mortgage. And so is that smart to get? Absolutely. What about paying for college, running a company? Those are all great uses for term life insurance. So what happens when the term ends? Well, scenario one, you no longer need it. And so you let it go. Your children are grown, they're independent, their education and your home is paid off. Your financial responsibilities have decreased to the point that you don't need the term anymore and you can let it end. What about scenario two? Well, if you still need life insurance, after your first term ends, you might still have a mortgage. I'm going to submit to you that there's this methodology for planning, again, which is plan A, that everything's going to work perfect and you're going to have your house paid off, your car's paid off, everything's going to be paid off. I live in the world of reality, and of the thousands of clients I have spoken to, I'm going to let you know that 99% of them do not fall into the plan A category. They get to retirement and everything is not perfect like plan A. So I'm going to encourage you as an educated listener of compounding communities, I'm going to encourage you to not plan for this perfect world plan A scenario, because the world and life is messy. And we know that most people are not still on plan A. So scenario two, after your first term, you may still have income and your expertise. It may be very expensive to replace you should you pass away. So, you may also find yourself in a situation when a term ends where you don't qualify for a new policy. Now, we actually have some term policies that have some guaranteed convertibility. And that's something that if your current term policy doesn't have a guaranteed convertibility, now a lot of them will convert to like a single year annual renewable type thing, but it gets crazy expensive. You go from paying like $50 a month to $500 a month. That's not what I'm talking about. I'm talking about convertibility, where you convert that term to something permanent and you maintain reasonable rates. We have those strategies, by the way. So it's not always quite so cut and dry. There's a lot of new features out there that you may not know exist. So if your term just comes to an end and you don't have any convertibility, you might look at upgrading and seeing if it makes sense to give you something with some options. Because a lot of times after a 30-year term, let's say you get that term at age 40, your 30-year term ends and you're 70. Most life insurance companies are not interested in writing you a new policy at the age of 70. And you may not need it, but you might. So if you do qualify for a new policy at the age of 60, 65, or 70, it's going to be very expensive because you're starting an entire new policy, right? So you're forfeiting your old approval that was probably when you were younger, weighed less, healthier, all those things back when you were in your 20s or 30s. So those are some scenarios that can happen at the end of a term. So there's this concept called the financial X wave, which we've already kind of talked about. But basically, at the beginning, you have more responsibility and you have less wealth. Okay. So that is a sweet spot for term. Okay. When you have a lot of responsibility and you don't have a bunch of wealth built up. As you get more wealth and less responsibility, term becomes less applicable, less desirable. That is where you might start looking at some uses for some permanent insurance. So let's talk through some of that. Permanent life insurance, like term, provides a death benefit to protect your family financially. However, it is designed to be kept for life, not just for term, not just for a short amount of time. Okay. So when you look at this, you might start term when you're young, but then you might use it later for the life insurance. You might use it for long-term care protection. You might use it for some supplemental tax-free retirement income. And then you might also want to use that money for a tax-free death benefit to pass on to your heirs. So now when you're talking about permanent insurance, you've got a lot more features, right? It'd be like buying just a basic flip phone that you know is probably going to last you maybe a year, one of those little Cricket phones from Walmart, versus buying a good quality, robust device that can last you for a long, long time, with a lot more features. That's the idea with permanent life insurance. Here's what you might be thinking. You might be thinking, yeah, but permanent is very expensive. Yes, in the 1970s, it was. Again, the world has changed, okay? There are new strategies, new products out there that are very cost effective on the permanent side. So 3 things to important benefits to look at. Permanent life insurance, the ability to add long-term care riders, and the ability to have some cash value. There are situations where you might initially look at term and say, this is very cheap and it covers me for 30 years. This looks good. And it may be the right fit. But there might also be situations where you look at a permanent coverage that at the end of 30 years, you have the choice to keep it or cancel it. If you decide to keep it, at that point, it doesn't cost you anything because you've already paid for it and it just stays in place. You're not having to continue to pay for this life insurance, but it stays in place for the rest of your life. Or option B, now perk your ears up here. Option B, you might be able to cancel it and then take the cash value that it has built up. And sometimes it's a little less than what you've paid for the life insurance. Sometimes it's equal to. So basically you get all the money back that you paid for the life insurance versus term, that money is gone. It's like renting. Or in some cases, depending on how you fund that permanent life insurance, you could have a significant chunk of money there that you can access. So not only do you have the life insurance coverage, but now you've got a chunk of money. You've got an actual asset versus something that was very temporary that expires. So there's some benefits to permanent life insurance that you might or might not have thought about. So what are some other benefits that we can add in? You've maybe heard the concept of bundling your home and auto, right? Now, bundling products is obviously a way that you can save money. Well, I'm going to submit to you that life insurance has kind of gone that same route where you can bolt on things that you also find value in, right? Bolt on a rider like a long-term care rider or a child rider or different terminal, critical, chronic illness riders you can add on that are there forever that will protect you even while you're alive. A lot of these riders, by the way, if you qualify for the rider, you can have money while you're alive to pay for treatment for heart attacks, strokes, cancers. Well, you think about how many families are affected by cancer these days. Imagine if you could have a big chunk of your life insurance money early while you're still alive to help you with the cancer treatment. That's what I'm talking about when I'm talking about life insurance, the new types of life insurance with living benefits, okay? That's what you need to have in place. But also you can have zero market risk on the money. If you're overfunding a permanent life insurance policy, you can have that money in a guaranteed floor account where the money sits there and it never loses money, regardless of market fluctuation. You can add long-term care. You can have tax-free growth on this money. I don't know if you've paid attention to what's happening with taxes lately, but there was a Forbes article. Just Google Forbes tax and Biden plan, and you can read kind of some of the new things that are happening in taxes. But taxes are on the way up. They're on the way up, and I wish that weren't the case, but it's there in black and white based on what's being proposed. Tax-free income later in life, pulling money out of these strategies to be used for income tax-free. And then the ability to create a tax-free legacy. Legacy is one of those things that occasionally you hear somebody that says, what's really important to me is I really want to set my family up for success. I want my generation to be the last generation that struggled financially. I want my kids to not have to live through some of the things I lived through in terms of financial stress. I think all of us collectively, you probably want your kids to be able to have a good life. You want them to look back and say, Mom and Dad loved me. Mom and Dad really did their best. They took great care of us. And now because of what they did, because the fact that they were financially educated, they left us a legacy. And now because of that, we don't have to struggle. We have some financial wealth. I'm going to submit to you that one generation, this is why it's so important that you're financially literate and educated. And as a listener of our show, that's why I'm so proud to bring you and teach you this information, because one generation of an educated individual understanding that you can pass money on tax-free to the next generation and you can create a legacy. One generation can be the snowball that kicks this down the hill, where now with proper estate planning, 2, 3, 4 generations from now, you can be talking about significant in the tens of millions of dollars of family generational wealth created by one generation of someone who understood how this game works. And so you have that opportunity. You have the opportunity to be that person in your family that is educated, that says, listen, no more generationally, we're not going to struggle as a family. My family name, the name on my back, that name is important. I'm proud of my family. I'm proud of where I came from. More importantly, I'm proud of where I'm taking this family. You get up every day to work hard to provide for your family, to provide to where that family name, it is something, and it is enduring, and it is something you're proud of. The ability for you to ensure that generations from now are doing just better and better and better, utilizing some of the concepts we teach you with tax-free legacy money going on, and the combination of proper estate planning, another topic that we talk about in our book. That is powerful. See, we're talking about more than just a little life insurance protection here. We're talking about changing a family for generations. Okay, so I want you to think, hopefully that's putting stretch marks on your brain in terms of of this is a little bigger than you might have originally thought when you got your job and you checked the box saying, yes, I'll take the free $100,000 of life insurance that my company gives me, and I'm good. I'm going to submit to you that there's a lot of things out there that you could utilize, and they hardly cost anything. And eventually they pay for themselves. So what can you use some of the cash in these permanent life insurance policies for? We can use it for whatever you want. You can use it for a car, vacations, weddings. You can use it for tax-free income in retirement. Also, by the way, some of you may not be familiar with the fact that in a qualified plan, the IRS controls when you can touch that money. And there's no guarantee or grandfathering what that age is when you get to retirement. So let's say you're putting all your money in your 401k and the rule is 59.5, or maybe the rule has changed to 62 or 65, or maybe it is similar to Social Security and it's 68. What if you want to retire and your primary income source is your 401k and the government has changed the 401k access point to age 65, but you're 61 and you desperately want to retire? You've been on this bus going to work every day, fighting traffic in Dallas or Austin or wherever you are. You've been getting up every day, trudging to work 5 days a week, working for the boss that doesn't appreciate you, or working in your dream job, whatever it is, but you have worked for 30, 35 years and you're ready to retire. You started working when you were 14 years old to help mom and dad. You're in that situation where you've paid your dues, but the government says, well, John, well, Sally, well, Susie, here's the thing, hey, Kimberly, the IRS says, look, Kimberly, we really appreciate the fact that you're 60 years old. You've paid taxes. You've voted. You've been a great citizen. But here's the thing, we control these qualified accounts and we know what's best for you. I know you want to retire now, but you don't know what's best for you. We, the government, we know what's best for you. And we have decided that the 401k qualified plan access point is 65. So you can't access your money. And if you say, no, I want to access my money, well, you're going to be hit with 20% in tax withholdings at a minimum and a 10% early access penalty on a portion of your money. So now you're talking about penalties to access your hard-earned money early. So what I want to submit to you is that there's nothing wrong with these qualified plans. There's some great uses for these plans, but there's some control issues happening. And this is a problem that is growing where people are being taken advantage of a little bit by a government that controls the rules. They control the access points. There's no grandfathering. So currently it's 59.5, but there's rumors that it's changing to 62 and that they're working it closer to 65 and 68, and that the new retirement age is going to be 70 moving forward because people are living longer. I want you to be prepared for this as an educated listener of compounding communities and as a member of our community, The Difference. I want you to be educated on this so that you know that the money you're putting into a 401k IRA, Roth IRA, you're not in control of when you can access that money. That's something that no one taught me when I was working in the tech industry, before I was into the financial industry. I had no idea that the current rule was 59.5. And if I wanted to retire at 55, tough cookies. The government decides when you can retire. So money in a permanent life insurance policy, extra money that you've socked away that's gotten growth, which, by the way, we've got a strategy right now that is tied to the S&P that's in a permanent type vehicle that got 44% rate of return. So if you're thinking, can these things even grow? Can they even get a rate of return? Absolutely they can. And they can get really good rates of return. So as a part of your overall portfolio, it might be worth having a conversation with a financial professional like me or someone you know, like, and trust about these topics, so you can make sure that you have the ability to access money to retire whenever you want, in addition to your qualified monies. So this is something that obviously I'm very passionate about, because I don't want to see you being taken advantage of, getting to age 59.5 or getting to age 62, planning the retirement party, putting your 2 weeks in, telling everybody, I'm ready, I'm retiring, I'm done, freedom, baby, catch me on the beaches of Mexico, only to wake up the next day to an article where the government has decided to change the qualified plan access point to 65. And you quickly Google, wait, am I grandfathered? I was just about to retire. No, there's no grandfathering. You have two choices at that point. Work another 3 years, unpack your Hawaiian shirt, put those loafers back on, head back to work, get back in traffic for another 3 years. Or you say, the heck with you, government, give me my money out of my 401k, which they penalize and tax you. So I don't want to see that happen to you. There are other options out there. So that's one way in which people are being taken advantage of because they don't know the rules to this game. I did not know the rules to this game, and you might have just learned something that could change your life. And so I appreciate you sticking with us and listening this far because, listen, there's some powerful cash advantages here. Tax-free growth. Also, one of the reasons why a lot of our doctor, dentist, high liability clients really like strategies like this is because the dollars in these strategies are protected from creditors. They're protected in the event that you might have some type of liability issue, bankruptcy. There's a lot of things there where you have a protected asset. Okay, that's important. Zero market risk, tax-free income. These are all big time things. Listen, I'm gonna break here and talk about two things. One, I'm going to talk about how people are being taken advantage of. The second way people are being taken advantage of. But before I get into that, I want to remind you, if you'd like a copy of our How Money Works book, where we get into more of the details of this, please comment hashtag the difference, hashtag compounding communities, or simply just say, I'd like a book. I'll have my people get your address. We'll mail you one of these for free. Also, our show is brought to you by Revolt Healthcare. You know, my friends over at Revolt, Ben and Mark and Stephanie and the whole team, they are experts at educating you on not only what coverage you have, the positives, the limitations of the coverages you have, but also educating you on what's out there available. And they've got a plan that I personally take advantage of. I'm very, very happy with it. I sat and researched it and watched it for almost 2 years before I made the switch and have been absolutely pleased with it. And now we have lots of my friends and family members that have taken advantage of the Revolt Healthcare health insurance product. It is saving people tremendous amounts of money. So if you'd like a free quote, it is very simple, very easy to get a free quote. In fact, I will, I'll have my website, my landing page that the guys over at Revolt were so kind to provide for me. There's a free quote page that these guys built me, and you can check out that page, scroll all the way to the bottom, enter your info. It's going to go to one person. One person is going to reach out to you, and they're going to say, hey, do you have any questions about the quote? Is it something you'd like to talk more about? If not, no big deal, totally okay. But the quote engine will actually send you a real number. This is not one of those things where you submit your information and it goes to 500 people. It's going to my friends over at Revolt, and it will give you an actual quote, not one of those things, hey, we'll contact you for more info. They'll send you a quote, and then they'll reach out to you and see if they can help you. So the link is scrolling down here at the bottom, or as always, you can comment, I'd like a quote for Revolt Healthcare, and I'll get you in contact with my friends over there at Revolt Healthcare, and they'll take good care of you. So the second thing is, this is the big thing. This is the thing that has me the most disturbed lately. Texas and many states, I think over 35 states in the United States, are what's called at-will states. Do you know what an at-will state means? What that means is you can work for a company and you can quit at any time for any reason. It is a protection for the employee, but is also a protection for the employer that says the employer can fire you. They can terminate you at any time for any reason. Okay. So if you're not sure about at-will states, now I'm not getting into, if there's harassment and stuff like that, that's a different ballgame. But I'm just saying, in general, the employee can say, hey, we love you, we appreciate you, but listen, the position that you're in is no longer needed. And so we're going to, give you 2 weeks notice, or effective today, we're going to let you go. Some of you have gotten those calls before. They're gut-wrenching calls when you get that call, usually Friday on the last day of the month or on a Friday, and it's like, hey, we appreciate you, but we're gonna have to let you go. So here's what's happening. Here's where families are being taken advantage of. And I want you to know this. I want you to be educated in this. And I want you to protect yourself from this happening. Because Texas is an at-will state, what's happening to people, especially now, is people are getting COVID. You get sick, you're sick for 2 weeks. Maybe you're sick for 3 weeks. If you go into the hospital, you're sick for longer, okay? So your job has the ability to let you go at any time. So for the first week or two, your boss is very encouraging. Hey, we hope you're hanging in there. Then you start getting the notes. Hey, can you make it back? When do you think you can make it back? We really need you. Hey, we might have to look at bringing someone in to do some of your position because it was really important. Do you think you can be back by the end of the week? And then maybe you can't because you're still sick. And unfortunately, they let you go. Or like the story that I just heard recently with a friend of mine, the dad worked so hard to get back to work, got back to work, had been gone for a couple of weeks, gotten out of the hospital from COVID, went back to work really before he should have, only to have his boss let him go the day he came back to say, hey, we're really sorry. We actually needed you a couple of weeks back. We got to let you go. Nothing he can do about it. Not a thing he can do about it. He was off of disability because he went back to work. They let him go. Okay. So now if and when he passes away, because he's still having some complications, if he passes away, now he no longer has the work provided life insurance. Can he go get life insurance now in his current health state? Nope. I've got another story of a client that got cancer, had to do treatment. It was incredibly disruptive to his life. He couldn't work. After a couple of weeks, his company fired him, let him go. Hey, we're really sorry. We got to let you go. Let him go. So the insurance that he had, his life insurance that he had, evaporates. He calls me. Can I get life insurance? No, I'm sorry. You have stage 4 cancer. There is, but outside of some guaranteed issue products, which are very expensive for very little coverage, there's really nothing he could do. Family, house, 3 kids, wife that stayed at home, horrendous financial situation when that particular person passed away because they had no life insurance. Now they had life insurance and they fell into the category of, I'm good. I've got life insurance provided through work. I want to submit to you, please do not rely on that. Please do not put your family in a situation where you are a sad story on a GoFundMe because your company let you go a couple of days before you passed away. This is happening and families are being taken advantage of. I'm seeing it left and right between GoFundMes, stories, people passing away of COVID, and your company has ended your employment. And so this is happening. It's happening all over the place. And people say, well, can I sue? I could go after the company, right? With what assets? With what money? If your loved one passes away and they were the primary income earner and now you've got medical bills and debts and you were already behind on bills because they weren't working, do you have the ability to go up against a major corporation? Do you have the ability to hire counsel to really fight a large company? That stuff is very cash intensive to hire counsel and hire attorneys and to go through those processes. Most of the time, people just turn and walk away. They say, well, the heck with them. Can't believe they did this to us. Can't believe that after all those years, they would do that to us. And well, they did. Sadly, this is what's happening to a lot of Americans right now, especially with COVID. So you're a listener of Compounding Communities. You're not going to let that happen. You're going to make sure that your family is protected. Okay. So here's the other thing. Long-term care, very quickly, long-term care, cash indemnity long-term care is something that pays your family while you are in need of some type of medical attention, whether that be in a nursing home or ding, 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 the big one, if you want to stay home. Or if you want mom and dad to be able to stay home in their house, but have in-home nursing care, in-home care, even money to remodel of maybe a first floor bedroom to make it ADA compliant, ADA accessible, make it to where you can have a full a full out or a semi-hospital bed in there. Maybe you don't necessarily want to pay what it costs with some of the horror stories of putting someone in a care facility. Okay. Long-term care pays monthly for the costs of either a facility or for the costs of someone staying home. It can pay for a doctor visit, it can pay for nurses, it can pay for equipment, but it can also pay for someone, maybe an adult child, right? Maybe mom is 85 and the daughter is 45 or 50 and she's a teacher. And she would need to, if she wants to stay at home and take care of mom, which she desperately does, she would need to replace at least 45, 50,000 of her income. Okay. So now we're talking about 50,000 of income that needs to be replaced. Well, 50,000 of income divided by 12 months is about $4,100 a month after taxes. You're talking about closer to 3,200, 3,500 a month. What if mom's long-term care policy is paying out $6,000 a month? So it can cover not only replacing the daughter's income so she can now quit her job, stay home, take care of mom, but also still pay for additional nursing and enhanced care. That is long-term care. And it is something that 7 out of 10 people are going to need, but 1 out of 10 people have. We can add that in. We can bundle that in with permanent life insurance, and it becomes very cost-effective and very useful. So that's something that we talk about in our book. It's something that I would submit to you. You might take a look at. It's way more cost-effective than you think. So with that being said, long-term care is huge. You look at the average long-term care need is 3.9 years. So the cost of 3.9 years, I've got it on the slide here that hopefully you can see here. I think we're pulling it back up, but the long-term care in an adult daycare, adult healthcare facility, you're talking about an average total cost of about $73,000. Median cost, $18,000 annual, okay, per year, right? What about an assisted living facility, private one-bedroom facility, $48,000 a year? Over 3.9 years, you're talking about $187,000. I'm going to stop right there and ask you, do you have that kind of money laying around, or are you comfortable liquidating some of your retirement? Or are you going to be in a position where you're going to have to sell some of mom and dad's assets or sell some of your assets to be able to, for your kids to afford to pay $48,000 a year for you to live in an assisted living facility? What I'm telling you is this can turn into a bad situation quick. Either you providing for your parents or hoping your kids can afford to pay for you to be in an assisted living facility. What about home health aid services? $50,000 a year. What about a semi-private nurse, not even private, a semi-private nursing home room? $89,000 a year. And if you'd really like to have your own private room in a nursing home, you don't want to necessarily listen to someone else snoring or yelling or whatever they're doing over there on the other side of the room that's separated by the white curtain. Well, that's going to cost you a cool $100,000 a year. And so are your kids going to be able to afford $100,000 a year, $8,300 a month, in addition to all their other bills? Or should you have a long-term care policy in place that takes care of all of that? As an educated listener of Compounding Communities, now you know what you need to do. You don't necessarily want to have count on someone else to be able to afford to pay for that. So like we talked about, long-term care can be added to a permanent life insurance policy, or it can be a standalone policy. There's pros and cons of both, but what I'm going to tell you is as a rider, as an addition policy on option 2, that is the typically the better way that you can do that. So some other benefits we've talked about and touched on: critical illness coverage in the case that you or a loved one has a heart attack, stroke, or cancer. And, cancer is one of those things that I don't know many families who have not been affected by cancer. And that can be financially devastating. What about chronic illnesses, ALS, diabetes, Alzheimer's? What about money coming out of a life insurance policy in the event that any of these things happen while the person's still alive? Okay, we're talking about life insurance awareness. We're talking about all the new features. We're talking about you having the newest iPhone 13 Pro Max version of the coverage out there, sometimes costing you less than the old stuff you were paying for. So listen, I just want to thank you for attending what we call kind of our master class for life insurance. It being Life Insurance Awareness Month, this is something that a lot of cases you don't want to talk about. You don't want to think about it. You just want to shove it in a box in a corner, and then in a deep, dark closet and not think about. But I promise you, your loved ones are worth it. Your family's worth it. You provide so much value to your family and loved ones. And on top of the emotional heartache that it would provide, that would happen if you passed away, the financial heartache is devastating as well. And so the responsibility on me, I want you to know it's not lost on me. The responsibility of me as a financial and insurance professional to deliver a check to your family, to deliver a payout of a large lump sum of money to your family when they're in a time of mourning, that's something that I don't take lightly as a response, as one of my responsibilities. And so, what does that check say? Well, that check says he loved you. That check says she cared about you. That check says he cared enough about us to have an uncomfortable conversation, to think about something he didn't want to think about, and put some tools, put some things in place that are going to assure our family's success. At the end of the day, this money says, from me to you with love, I want you guys to go on and be able to carry on without the financial stress, without a financial disaster in the wake of my passing. That's what this says, okay? This is about you and you taking care of your loved ones as much as anything else. The other benefits are certainly huge: long-term care, cash accumulation, tax-free ability to use monies. Those are all really cool perks, okay? So I really appreciate you. The compounding communities, this is something that is near and dear to my heart. And as a listener of the compounding communities, if I can help you with any of this stuff, please don't hesitate to reach out. There's never any charge or anything to look at some of these topics for you. Look at term, temporary, look at some permanent coverage, look at some of these benefits. So if I can help you, but if not me, I would just encourage you, please go talk to someone. Please make sure that you've got this category of your life in order so that you don't have to worry about it. This show has been brought to you by Revolt Healthcare and WealthWave, the How Money Works company. I really appreciate you as a listener of our show, and have a great day. Have a great evening. We'll see you on the next one.